Hello dear students, welcome to our last video of case scenario discussion. So here we are doing the last 5 set questions 31 to 35. So without wasting time, question number 31. On 1st October 2011, Skywork Limited has signed a contract to purchase a machine from foreign supplier on 31st March 2012. So this is the date of entering into the contract to purchase a machine on 31st March. The purchase price of the machine is payable in cash on 31st March 2012 was 2 USD 2 million. On 1st October, Skywork Limited entered into a forward contract to purchase USD 2 million on 31st March 2012 for 140 million. So for $1, 70 rupees, 140 divided by 2 for 70 rupees, you entered into a contract to buy this foreign currency. On 31st December 2011, okay, maybe end of the year, a contract to buy USD 2 million on 31st March 2012 would have required a payment of 150 million. Okay, you already entered into a contract to buy for 140 million. If there was no such contract, you had to pay 150 million. Okay, so there is a gain of 10 million in that forward contract. The forward contract was settled, or sorry, on 31st March, the spot rate was 70. The forward contract was settled by other party making a payment of 15 million to Skywalk Limited on that date. Skywalk Limited estimated that the useful economic life of the machine was 5 years. So you are buying a PPE, so the useful life of the PPE is 5 years from 31st March 2012 with no residual value. Skywalk Limited uses hedge accounting whenever permitted by Ind AS 109. The currency contract fully complies with the criteria and condition for hedge accounting as set out in Ind AS 109. Okay, so here they are asking you the questions on hedge accounting. The company is following hedge accounting. So which type of hedge it is? Conditions are satisfied. Then which type of hedge it is? Which type of hedge is it? Fair value hedge, not fair value hedge. Why it is not fair value hedge? Fair value hedge means already an asset or liability is appearing in the balance sheet, and to protect its fair value fluctuations, we are entering into a contract. Here it is cash flow hedge because you are entering a contract on 1st October which results in outflow of cash on 31st March 2012. So there is cash flow hedge. So what is the accounting treatment of cash flow hedge? So to understand the accounting treatment, what is a hedged item? Hedged item is the contract to buy a machine, PPE. Hedging instrument is the forward contract to purchase $2 million. So here on 1st October there is no entry, but subsequently every reporting date you need to understand the gain or loss on this forward contract, and that gain or loss should be transferred to statement of P&L. No, gain or loss should be transferred to cash flow hedging reserve in OCI, and that amount gets accumulated in cash flow hedging reserve, and at the time of settlement the amount in cash flow hedging reserve is to be reclassified to P&L but not directly to P&L. Adjust the carrying amount of that purchases or sales whatever you have made. So please refer the type of questions we have done. We have never reclassified to P&L, but we adjusted against the purchases or sales. Okay, so now what are the questions? Show the amount to be recognized in balance sheet at 31st December 2011 of PPE purchase. But 31st December 2011, we have not recognizing PPE in the books. So PPE will be recognized only on 31st March 2012. So here nil, nil, nil. Amount is option D. Calculate the gain on revaluation of derivative for the year ended 31st December 2012. Okay, so 1st October, no entry. 31st December 2011, we'll recognize a gain of 10 million. Now, it is given in the question that the forward contract was settled by other party by making a payment of 15 million to Skywalk Limited on that date, which means on 31st March 2012, 15 million is paid by the other party to us, means there is a further gain next year 31st March 2012, but for the year ended 31st December 2012 there is a further gain of 5 million. So here answer should be option A, 5 million. Calculate the net carrying amount of PPE as at 31st December 2012. Calculate the net carrying amount of PPE. So we are purchasing the PPE on 31st March 2012. How much? For how much? PPE will be purchased for 140 million. 140 million. Okay, because 70 rupees, 140 million. And there was a gain of 15 million from the hedging instrument that will be adjusted against that purchase, sales or PP, whatever item you are purchasing. So 15 million we are deducting because it was a gain. So 125 million should be the carrying value of the machine. So 125 million in depreciation is 5 years and 9 by 12. Why 9 by 12? Because we are acquiring on 31st March 2012. Depreciation on 31st December 2012. 9 months. 9 by 12. So it is coming to, let me calculate, it is 18.75. So 125 minus 18.75. 106.25 million. 106.25 million. Now, at what time the hedging instrument as derivative in this case is to be de-recognized from books? Hedging instrument will be de-recognized from the books when the PP has been purchased, when the forward contract is settled, when company starts depreciating PPE at the end of the financial year, when the contract is settled, when the forward contract is settled is the correct answer. When that forward contract is the hedging instrument, when that is settled, then it will not come in the books. Okay. So nil 5 million, 106.25. Okay, fourth one. When the forward contract is settled. Okay, fine. Now case scenario number 32. Mr. H is a chartered accountant and is working in GHI and Company Chartered Accountants as a manager. GHI and Company has recently approached by A Limited for providing advice on certain accounting matters. A Limited is an automotive supplier. A Limited is an automotive supplier having registered office in New Delhi and is listed on Bombay Stock Exchange. A Limited has a machinery costing 15 lakhs. Useful life of 10 years. Estimated cost of major overhaul planned after 3 years is 2 lakhs. So 15 lakhs should be divided into 2. 2 lakhs and 13 lakhs. 2 lakhs should be depreciated over 3 years and 13 lakhs should be depreciated over 10 years. Okay. A Limited received a subsidy of 15 lakhs from government in Northeast India in return for setting up approved industrial activities in those states. Okay. One of the key conditions of the subsidy is that A Limited needs to employ the locals staying in those states. Oh, so subsidy is received for a period of 5 years. So that 15 lakhs should be spread over 5 years. 3 lakhs per annum should be recognized as income. Now, A Limited offers 400 shares to each of its 1000 staff if they stay with them for 3 years. The fair value is 50. At the end of year, 120 employees left. An entity estimates that total 25% of employees at the beginning of the grant will leave at the end of the vesting period. During the second year, a further 20 employees left and entity further revises its estimates of total departure over vesting period from 25 to 28%. During the third year, a further 20 employees leave the entity. So here, what should I do? Very easy. 1000 into 25% will leave. So 750 employees into 400 shares into 1 by 3. So it is 750 into 400 into 50 divided by 3. So 50 lakhs is the expense for first year. Second year, 720 into 50 into 400 divided by 3 into 2. Minus 50 lakhs, 46 lakhs is the expense to be recognized in the second year. And third year, so total 20 plus 20, 40, 60 employees left. So which means 940 into 50 into 400. is the total expense, of which 96 lakhs is already recognized, so balance 92 lakhs. Let's see what the questions are. Considering the principles of Ind AS, determine the accounting for machinery. 15 lakhs should be depreciated, no. 13 lakhs over 10 years and 2 lakhs over 3 years. Option B. How should I'm not 13 lakhs should be major overhaul, 2 lakhs should be recognized. No, option B is the right answer. How should A Limited account for subsidy? Subsidiary should be recognized at the end of year 5, should be recognized over a period of 5 years, 3 lakhs per annum. Determine the amount to be recognized in statement of P&L. 50 lakhs, 46 lakhs, 92 lakhs. Option C. Option B. Option C. Key scenario number 33. Mr. H is a chartered accountant of GHI. Okay. Now, what is given? As on 1st April 2011, A Limited has opening shares of 10 lakhs. On 31st May, issued 2 lakhs. On 30th November, A Limited made a bonus issue. 28th February, A Limited issued another 2,50,000 shares. If you remember, this is exactly an illustration in Ind AS 33. So here, how do I calculate? The question was to calculate weighted average number of shares in that question in the study material illustration. So here, what should I do? Opening 10 lakhs. But there is a bonus issue on this date. So bonus issue normally considered as issued at the beginning of the previous year. So the bonus issue for this 10 lakh shares, 1 for every 3, which means 10 lakhs divided by 3, 3 lakh 33, 333, right? Three lakh 33, 333 will be taken from the beginning. So this into 12 by 12. I'm not going for cumulatively, I'm doing separately. Then issue 2 lakh shares on 31st May. So April, May, 2 months, 10 by 12 I need to take. But 2 lakhs plus 2 lakhs divided by 3. 66,666. 2 lakh shares are not issued at the beginning. So it's bonus shares I cannot assume from the beginning of the previous year. So I'll count from this date, from 31st May. So this into 10 by 12. And bonus issue will not be considered because it's already included. 28th February 2012. So February, March, just for 1 month. 2,50,000 into 1 by 12. So 13,33,333 into 13,33,333. 2,66,667 into 10 by 12. So 13,33,333. 2,22,222. And 2,50,000 into 1 by 12. 20,833. So 13,33,333 plus 2,22,222 plus 20,833. 15,76,380. 388 or 389 is the weighted average number of equity shares. Let's find out what the question is. Determine the weighted average. 15,76,389. Okay. Now, A Limited has agreed in directors meeting to sell a building. Okay. We agreed to sell a building and has tentatively started looking for a buyer. The price of the building has been fixed at 4 crore and a surveyor has valued the building for 3.6 crores. A Limited will continue to use the building until another building has been found with equivalent facilities and in a suitable location for the office staff who will not be relocated until the new building has been found. Okay. How should A Limited classify the building in the given scenario? Is it PP, inventory, held for sale, investment property? What is your answer? PP. Because until the new building is found, this building will be used. Held for sale conditions are not satisfied. So it will be continued to use as property, plant and equipment. Classified as property, plant and equipment. Okay. Now case scenario number 34. DEF Limited is a diversified business group operating in multiple business segments across different parts of the world with multiple subsidiaries. It maintains its books of accounts and publishes its annual financial statements under Indian accounting standards. The finance team has been working on closing the books of accounts and generating financial statements. Okay. And it is facing some issues in the following transactions. Profit attributable to ordinary equity shareholders 12 lakhs. Weighted average number of ordinary shares 5 lakhs. Average market price of one ordinary share 20. Weighted average number of shares under option 1 lakh. Excise price 15. So options, number of shares, profits, basic EPS, diluted EPS. Maybe let's see the question. Based on the facts given in scenario 1, what will be the basic EPS? Basic EPS is 12 lakhs divided by 5 lakhs. 12 divided by 5. Is it 2.4? 2.4, option B. Now, based on the facts in scenario 1, what is the diluted EPS? Diluted EPS, so 12 lakhs plus 0 because there is option. So no additional profit, 0 divided by 5 lakhs plus, what is the bonus element? 1 lakh into, what is the, how much is free? 5 out of 20. Yes or no? 5 out of 20. So 5 lakh plus 25,000. So 12 lakh divided by 5 lakh 25,000 is how much? 12 lakhs divided by 5 lakh 25,000. 2.285. 2.285. 2.29. Option A. Okay. DF Limited enters into a contract to buy 100 tons of cocoa beans at 1,000 per ton for delivery in 12 months. On the settlement date, the market price of cocoa beans is 1,500 per ton. The contract cannot be settled in cash. Oh, if you entered into a contract to buy or sell a non-financial item which can be net settled, Ind AS 109 will apply. Gross settled, it cannot be settled in cash. It requires delivery or settlement. Then what is the question? What is the nature of contract? Cash contract, non-executory, derivative contract, executory and non-derivative. So you entered into a contract to buy 100 tons at 1,000 per ton for delivery in 12 months. So here the delivery will be in 12 months. So it is executory. It has not executed, and it is more appropriate as executory and non-derivative. It cannot be considered as a derivative contract. It is non-derivative. Okay. What is the nature of financial instrument? DEF Limited invests in compulsorily convertible preference shares (CCPS) issued by its subsidiary B Limited at rupees 1,000. 10 rupees face value and 990 premium. Under the terms of the instrument, each CCPS is compulsorily convertible into one equity share at the end of 5 years. Such CCPS carry dividend at 12% per annum, payable only when declared at the discretion of B Limited. So we have seen a similar question. So here it is, what is the nature of contract? Equity. Compulsory convertible with discretionary dividend as equity. Okay, now last scenario, 35. PQR Limited is required to adopt Ind AS from 1st April 2011 with comparatives for 1 year. Okay. On 1st April 2011, PQR Limited acquired 30% of the voting ordinary shares of XYZ Limited for 8,000 crores. PQR Limited accounts its investments using equity method. So the same question is there in our study material, illustration 11 in business combination. Or I think here in case scenario itself, I think we tried this question. PQR recognized the share of net assets because it is Ind AS 28. Share of profit and loss, share of exchange difference, share of revaluation Reserve, this will be added, and the investments carrying amount is 8850. On 1st April 2012, PQR acquired remaining 70%, step acquisition. So already you had 30 plus you acquired 70, so 100% shares you acquired for 25,000 crores, and 30% of shares already held. Fair value is 9,000 and identifiable assets is 30,000. What is the fair value of total consideration? Total consideration is now you paid 25,000 for 70%, and fair value of previously held interest is 9,000. So 25 plus 9, it is 34,000 is the PC. Option A. What is the amount of goodwill? So 34,000 is PC. There is no NCI, but net assets taken over is 30,000. So 34,000 you are paying. Net assets is only 30, resulting in a goodwill of 4,000. Option B. What is the gain on previously held interest? Actually, our investment is standing. Carrying value of investment as on that date is 8850, which has become 9,000. So there is a gain of 150. Also, there is an exchange gain of 100, which is to be reclassified to P&L. So total reclassification, there is 100. So total gain to be recognized is 250. 250. What is the transition date? See, it is given in the question that 1st April 2011 is the date when you have to apply Ind AS. So 11-12 is the first financial year. Previous year is 10-11. So beginning of previous year is 1st April 2010. 1st April 2010. Option A. PQR Limited presents its comparative financial statements for the year. So comparative financial statements 11-12, for which you prepare Ind AS financial statements. So comparative is 10-11. Then 1st April 2010 also you'll show, but comparative year is 10-11. So that's it, guys. It's done. All the case scenarios have been done. So maybe you can adjust speed and watch, but please don't miss it. All the best. Do well.